The phrase, "something extraordinary just happened in the gold and silver market," has become such an overused line that most people barely react to it anymore. Not because it's false, but because the pace of escalation has become so relentless that extraordinary is now occurring almost by the hour. The danger isn't exaggeration. The danger is normalization. When structural breaks happen this frequently, the public stops recognizing them for what they are: irreversible shifts in the global financial order. Today is one of those moments. Because what we are about to examine is not a price move, not a chart pattern, and not a speculative narrative, but two hard, undeniable developments that are now reverberating far beyond the precious metals market and straight through the core architecture of the global economy. These are not signals. These are confirmations. And history will mark this phase as the point where positioning quietly became destiny. If you've been stacking gold and silver ahead of this moment, you didn't get lucky. You understood the system before it admitted the truth. And today, the system just admitted it. Before we dive in, if you value deep, unfiltered analysis of the forces reshaping money, power, and markets, and not surface-level commentary, make sure you're subscribed. These developments are accelerating, not slowing down. Now let's start with the first breakout story, because this one changes everything. President Donald Trump has just announced the creation of a critical minerals reserve, a government-backed stockpile worth nearly $12 billion, explicitly designed to counter China's dominance over the metals that modern civilization cannot function without. The initiative, now branded Project Vault, was unveiled at the White House with language that should have sent shockwaves through every market participant paying attention.
For years, American businesses have risked running out of critical minerals during market disruptions. Today, we're launching what will be known as Project Vault to ensure that American businesses and workers are never harmed by any shortage. We don't want to ever go through what we went through a year ago. Just as although it did work out, thank you. Just as we have long had a strategic petroleum reserve and a stockpile of critical minerals for national defense, we're now creating this reserve for American industry, so we don't have any problems. This historic initiative will combine $10 billion in export-import bank financing with $2 billion in private sector financing, and we even expect the American taxpayer to make a profit from the interest on the loan used to start the Project Vault. It's an amazing thing. They've been talking about it for years. Other presidents did a lot of talking, but they didn't do anything.
Today, we're launching what will be known as Project Vault to ensure that American businesses and workers are never harmed by any shortage. That sentence alone tells you the shortage already exists, and it's about to hit the global economy very hard. Trump also directly compared Project Vault to the Strategic Petroleum Reserve, created in the 1970s after the Arab oil embargo crippled the U.S. economy and reshaped global geopolitics for decades. That comparison is not symbolic. It's structural. The SPR wasn't just about oil. It became a pillar of the petrodollar system, anchoring U.S. monetary dominance to energy security. Now pause and absorb what this means. The President of the United States is openly declaring that critical metals, are now as strategically vital as oil once was. And silver, after decades of suppression, dismissal, and paper manipulation, has just been added to that list. This isn't a footnote. This is an admission. In plain English, the U.S. government is preparing for a world where metal scarcity is weaponized. And this didn't come out of nowhere. During trade talks last year, China restricted the export of rare earths essential for jet engines, radar systems, electric vehicles, laptops, and phones. It was a pressure test, and it worked. China controls roughly 70% of global rare earth mining and an astonishing 90% of global processing capacity. That dominance gave Beijing a chokehold, and Washington felt it immediately. Trump even referenced it directly. We don't want to ever go through what we went through a year ago. Translation: the U.S. discovered it does not control the materials that underpin modern power. And now connect the dots, because this is where it becomes historic. At the same time China is tightening its grip on physical resources, it has just announced its ambition to elevate the yuan into a global reserve currency. The symmetry here is staggering. The United States has the world's reserve currency, but no strategic reserve of critical metals. China has the metals, but not the reserve currency. And now both are racing to fix the weakness the other can exploit. This is not trade policy. This is financial warfare. And silver sits right at the intersection: monetary metal, industrial necessity, strategic resource. This is the US government publicly validating what stackers have been saying for years. The petrodollar phase is ending, and the next phase of the global monetary system will be built on real assets, physical constraints, and strategic metals. This is not theory. This is policy. And while governments are moving quietly but decisively, institutions are doing something even more revealing. Which brings us to the second story. While headlines were focused on price destruction during Friday's crash, something extraordinary happened behind the scenes in the silver market. Something that only shows up after the violence. A recent alert highlighted what can only be described as a structural anomaly. The largest one-day silver price drop in history was followed immediately by the creation of 36.3 million new shares in the SLV ETF. That translates to approximately 32.9 million ounces of physical silver deposited into the fund in a single day. Let that sink in. This was not during a rally. This was not momentum chasing. This was not retail enthusiasm. This happened after a forced liquidation event, after margin calls, while COMEX was under delivery pressure. Here's the math, because this isn't narrative, it's arithmetic. Shares outstanding jumped from 550.5 million to 586.8 million, an increase of 36.3 million shares. At roughly 0.905 ounces per share, that equals just under 33 million ounces of physical silver added in one day. That is not normal. That is not emotional. That is not accidental. SLV operates on a simple rule. If authorized participants want new shares, they must deliver metal first. Which means when price collapses violently and tens of millions of ounces appear immediately afterward, it tells you exactly what happened. Someone with deep pockets used the price smash to source physical silver at distressed prices and park it inside institutional vaults. Retail didn't do this. Retail can't do this. This was metal migrating from weak hands, forced sellers, and leveraged positions into balance sheet silver controlled by institutions. Price fell. Metal moved. Ownership changed. And this didn't happen in isolation. At the same time, COMEX registered inventories were declining, delivery obligations were heavy. JP Morgan was stopping hundreds of contracts, and ETFs that had been bleeding metals suddenly reversed course and refilled. This is not demand chasing price higher. This is inventory reshuffling under stress. Markets always confess after the damage is done. Price is the weapon. Inventory is the confession. And right now, the confession is screaming. To understand what really happened on Friday, and why the violent sell-off was not a signal of weakness, but a mechanical event, you need to step away from headlines and listen to someone who has watched these cycles unfold for decades. David Morgan was warning weeks in advance that gold and silver were going vertical, that leverage was piling up dangerously fast, and that once a market reaches that parabolic stage, the correction isn't optional, it's mathematical. Not because the fundamentals break, but because leverage always does. What Morgan explains next is critical. This was not a collapse of demand, not a rejection of silver's role, and not the end of the move. It was the inevitable snapping of an overstretched derivatives market, one that was structurally incapable of absorbing even a modest shock without cascading liquidations.
Yeah, for, I don't know, a couple of weeks, maybe more, I'd been saying, now show me a chart. Don't tell me what the commodity or the stock is. Just show me that parabolic move. And I will tell you, I don't care if it's corn, soybeans, or IBM shares. This move will not sustain, and it's going to see a big correction. I just don't know when, but it's sooner than later. And so I caution my, paid subscribers and also the public at large, let's not get too greedy here, and we're going to see a correction. And I indicated it could be a healthy one. Of course, no one knows until after the fact. So what happened was we are in a leveraged market, as we all know. It's a derivatives market. And I think the best outline of what really took place is on X, and it's Solix Trading, SOLIX Trading. And I just reposted it on my X feed. So it's a repost. What happened Friday is the edit I made to it. And it's I'm at Silver Guru 22 on X. So if you want to read all the details, go there. But briefly outlining it, Michelle, the AGQ is a 2x leveraged silver ETF, and it aims to deliver twice the daily performance of the silver price using futures and other derivatives. So what happened when the silver prices started to plunge, the AGQ being leveraged didn't move by half. It dropped by about 60% in a single session. So from that aspect, you could say it was more than Silver Thursday, but I don't want to, go into the minutia yet. Because the fund's mandate is to maintain a 2x exposure each day, it was forced to sell futures to rebalance the fund. And of course, selling begets selling. So say that AGQ had $5 billion in assets. That means $10 billion in silver exposed at the start of the day. A 20% drop would reduce their value to about $3 billion. Think about that. 10 to 3 in a day. To reset the exposure back to 2x, the fund must cut exposure from 10 billion to 6 billion, meaning roughly 4 billion of future sales dumped into the market around the worst drop or almost the worst drop in history.
But in this particular move, do you get a sense that there was any kind of coordinated manipulation happening here?
Not really. Let me just reiterate what I said, maybe make it a little more clear. So the AGQ didn't cause, quote unquote, the initial. It was a macro headlines, a dollar spike and repricing after the Fed narrative shifted. So if I could go back to my notes about, cause and effect. So the first thing that you'll get in the mainstream press was that there was a big shock to the system because this washed the market, meaning, I'm trying to be funny here, Michelle, but he was nominated, or the narrative was stated that he would become the next Fed chairman under President Donald Trump's appointment. And many people were under the impression that Trump was going to put in a dove, a very a system leader that would say, hey, look, we're going to keep lowering interest rates. We don't care what the market says. And here comes a guy who's pretty much known as the opposite. He's known as a hawk. Whether that's the truth or not remains to be determined, depending on how manipulated the interest rates are from the Federal Reserve. So the positioning had already been stretched, as I said weeks earlier. Gold and silver become moving vertical, that kind of upside, a market becomes fragile. I mean, the leverage rises and liquidity thins. You throw a ball into the air, when it starts off, you give it a lot of force, it's fast, it slows down, it stops. Momentum stops, it stops momentarily, and then it starts down. That's a good analogy. It only has so much buying power, even from these massive banks. The banks are net short the last time I looked. So they're waiting for some kind of sell-off. So I don't want to make the AGQ the exact trigger, but it certainly played a part because it's double leverage. So you're leverage upon leverage. So you get the point. And because it was stretched, we were just due. So now what happens? A mechanical accelerant happens because margins had been, margin hikes were going to occur after the close. And this forced liquidation. So people that were putting up, the normal 8%. So look, at $100 silver and $5,000 gold, it takes $44,000 in margin to hold one contract, but $75,000 to hold the same amount in silver. Both those contracts are worth $500,000. So again, at 5,000 gold, 100 silver, they're the same paper value exactly, $500,000 per contract. But one takes $44,000 to hold a position and one takes $75,000 to hold a position. You can see where I'm going with this, Michelle. Most of these people that trade futures, even the funds, are over leveraged and undercapitalized. And so it doesn't take much to kick the can a different direction than what they're betting to get this kind of a fall off.
So there was also some speculation online that these margins were increased excessively in order to force the sell-off, that the CME dramatically increased the margin positions quite significantly as we've been seeing this run up, and pushed it to a point intentionally to sort of flush out these positions.
Well, that's subjective. I mean, you can make an argument either way. It can't really be proven, but what we know for a fact, Michelle, is that the exchange has to protect themselves. I mean, they do have a dog in the fight. They are responsible. So in order to mitigate any, let's say, counterparty risk, which is tons to mitigate the risk, to lower the risk, they have to do what they have to do. And of course, they set that basis. I don't know if they have a math formula or not, but they basically say, look, it's really wild. We have got to mitigate this, and therefore they raise the requirements. Again, I just go back to what I said a moment ago. Gold is much more stable. 10% is a big move in any market, but silver was 3x the gold move in percentage terms. And therefore the margin was significantly higher, almost double, not quite, but almost double the margin needed for a gold contract in those turbulent times, saying that silver is more turbulent, therefore more margin. I don't think it was unfair. I mean, people that trade futures, they sign a contract. If they don't read it, that's their problem. I mean, I traded futures for years. I do it very sparingly these days. But nonetheless, you can't complain about the game if you sign a document saying you know what the game is.
The key point Morgan emphasizes is this. Once a market goes vertical, it only has so much buying power left. Banks were already net short, positioning was stretched, and the moment momentum stalled, gravity took over. Add margin hikes into that environment, and liquidation becomes automatic, not discretionary. This wasn't silver failing, it was leverage being purged. And when leverage is wiped out in a single session, what's left behind is not damage, but clarity. Which brings us to what happened after the crash, because that's where the real story is now unfolding.
Let's separate this. Is there still a price difference between Shanghai and the London, New York market? And the answer is yes. And let's separate the signal from the noise. Gold, according to Reuters, Reuters reported China's trading at a premium versus a global benchmark up to $32 per ounce in gold. That was about $8 differential the prior week. So going into the break, actually the spread widened. So that's according to Reuters. So I'm citing my source. Silver, you'll see lots of claims about massive, persistent spreads. Some of these are methodology games, looking at different products, taxes, VAT, conversions, different delivery terms, all kinds of stuff gets in the mix. It's never really talked about, but they'll show you a picture from eBay and claim, that's the differential. So treat a lot of that as noise. But the actual verified is, yes, there's still a spread in silver between Shanghai and New York. And the last I looked, it had been widened from what it had been pre. So the bottom line is the spreads exist due to capital controls, import rules, taxes, financing, the form of delivery, but the arbitrage is still there. It's obvious. And it does point to the fact that the physical needs in Shanghai at this time still exist.
What do you think happens next year? Do they sort of come back into play? Is this a short-term pullback? What's your read on what the next move in the silver market could be?
Well, first of all, I think what it does re-emphasize, first and foremost, it matters the most to the public because the public will learn again to distrust paper claims on gold and silver. Even inside China, and I know we could, if we have time, talk about what's going on there with some shenanigans with not being able to deliver. We'll address that later. But that's number one. If you don't own it, you don't touch it, don't hold it, you don't own it. So I think that's been re-emphasized. The second thing is none of the fundamentals change as you outlined so eloquently. Lastly, it's an opportunity for people that are late to the party. I mean, there's people that watch silver go from the $50 breakout all the way to like 120, last week, and saying, oh, I missed it. Now they're seeing it below 80. It's off, 5.5% right now, as I look at the last one I have on the chart here, and it's $80. So 80 to 140, that's a big percentage move just to get back to where it was, a few days ago. And I think it will do that. I don't think this is over by a long shot. In fact, I'd almost say I know, but I don't want to get in trouble with the authorities. But all indications are nothing's changed other than over leverage. That's been wiped out in a day. It'll probably take a couple more days, Michelle. Usually these type of what I call waterfall declines take about 3 days at a minimum just to clear the books. I mean, there's people that say, yeah, I'll wire the money. I'll cover my margin. And guess what? It doesn't come in time. Then what happens? Well, they sell them out. So there's a lot going on kind of behind the scenes that needs a few more days in order to clear the market.
So what does all of this mean, and what's happening with silver today? While paper markets were busy cleansing themselves, The physical market wasted no time reasserting reality. Shanghai silver prices snapped right back to $123, while COMEX silver, after the smoke cleared, pushed back above $81, reopening a gap of more than $42 per ounce between East and West. That is not noise. That is a signal. And once VAT, capital controls, and logistics are factored in, the arbitrage to move physical silver into China exceeds $34 per ounce, even after shipping and insurance. That kind of spread does not persist unless physical demand is urgent, persistent, and unmet. At the same time, the supply side is deteriorating in plain sight. Three major global refiners, Johnson Matthey, Metallur, and Heraeus, have either declared force majeure or cut production sharply, removing over 60 million ounces of annual refining capacity from the market due to equipment failures, feedstock shortages, and energy cost pressures. This is not a future problem. This is a present-tense constraint colliding directly with rising physical demand in Asia. So when Morgan says the fundamentals haven't changed, he's understating it. The fundamentals have actually tightened. What Friday accomplished was simple and brutal. It flushed out over-leveraged paper positions, re-educated the public on the difference between ownership and claims, and handed latecomers a window they didn't think they'd get again. The market is now in the process of clearing the wreckage, and once that process finishes, price will be forced to reconcile with reality, because physical silver is already doing so. And this brings us to the final question the market now has to answer. What happens when physical demand accelerates at the exact moment paper inventories are thinning, refining capacity is shrinking, and arbitrage begins pulling metal out of Western vaults altogether? That's where the story goes next. The United States is racing to build a critical minerals reserve. China already controls the metals and is racing for reserve currency status. Both sides see the same thing. You cannot run a modern economy, a military, or a monetary system on paper alone anymore. Critical minerals are no longer inputs. They are leverage. And silver sits right in the crosshairs of that fight. So here's the real question for this audience. When governments are stockpiling metal, why would you be trading it? When refineries are shutting down, do you think this pullback was a warning or a gift? And when the East is paying $40 more per ounce than the West, which market do you think eventually adjusts? This isn't about timing tops and bottoms anymore. It's about which side of the supply chain you're standing on when the scramble turns visible. If you're here for analysis that connects physical metal, geopolitics, and the collapse of paper illusions in real time, like this video, subscribe to the channel and turn on post notifications for more insight deep dives. Thanks for watching, and see you in the next one.